Coming up on today's show, the chaos that's going on under the hood in the stock market, why this stock was up 200% today, Donald Trump making major moves and how that impacts the market. And of course, we have to talk about the biggest stock in the world and the impact it'll have on 2025. We've got a lot to talk about. Let's roll the tape.
Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks rose on Monday as chip names outperformed and investors awaited the release of key monthly jobs data this week. And guys, it was a very mixed day, but a positive day in some sectors, a negative day in some sectors. Such goes the market with the big boys, the Magnificent Seven, really taking the cake. Look at Google, look at Meta, up 2 and 3% respectively, just above those numbers. Nvidia up 4.10%, and the entire semiconductor space really rallying except Intel. You see equipment manufacturers on the semi space also rallying. So yeah, semiconductors really getting a groove on to kick this year off. These are huge moves in the semi space. Microsoft gained, Apple gained, Amazon gained, Magnificent Seven gained, and all in all, Tesla was the only Magnificent Seven name that didn't perform today, but it has been the outperformer in the past 6 months. But other than that, it was mixed price action through and through. I mean, just look at software application. It was very green and some of the bigger names outperformed. And that's really what we saw today. Look at utilities, GEV and CEG. They outperformed when utilities were broadly red, the bigger names in each sector. Walmart and Costco, they outperformed when the broader sector was red. They're the biggest names in each sector. Look at financials, Bank of America, Wells Fargo, PayPal, Capital One, Morgan Stanley, Goldman Sachs. Not the biggest names, but certainly big names nonetheless. They outperformed when the broader market or the broader sector underperformed. And that was really the theme today. We again saw a rotation into large size, large quality. And if we actually look at the sectors that outperformed, again, we see at the top XLC, XLK, XLY, these Magnificent Seven sectors. But very interesting to see XLB materials up there, up 0.62%, actually outperforming the S&P 500, which is up 0.52%. And again today, we saw some very good volume come into the market. So, maybe by the end of this week, we should see back to pre-Christmas volumes in the market. But maybe we still should see a light week of volume because we do have a day of training later this week for Jimmy Carter's remembrance, I believe, on the 9th. Nonetheless, guys, the market is still open. It closes in a couple of minutes, but the SPY up 0.52% for the day so far. The XLP staples was the worst performing sector along with real estate and then utilities as a whole. So we really see defensive sectors getting shunned here, cyclicals and growth getting bought for the most part. About a week ago, we were talking about a possible defensive rotation, or we were seeing a value rotation under the hood. That seems to be very short-lived. On the defensive side, that's very, very good. You don't really want to see a defensive rotation because that means trouble lies ahead because the institutions normally see something that we don't. When you see that defensive rotation, not a good sign, and we aren't seeing follow through of that. And that really goes to show the market we're in. You can actually see mid caps, large caps value didn't do so well, and small cap value underperformed their counterparts of core and growth respectively. In fact, mid cap value, large cap value were the worst performing sectors here today, down 0.3 and 0.09 respectively, with large core, large blend up 0.63, the best performing factor segment. And then we actually saw just a large size do very, very well. But mid-cap growth up 0.46%, putting on a show as well. And then we actually saw broad-based positive action in small caps, but broad-based positive action across the board, across factors and sizes, but particularly in the chip space. I mean, guys, MU was up 10.79% and chips rose across the board on Monday after Taiwanese electronics contract manufacturer Foxconn reported December sales ahead of analysts' expectations. Now, Foxconn assembles Apple iPhones and data centers for hyperscalers such as Google and Meta, and it uses the world's most advanced chips from Nvidia. Now, Foxconn's performance is seen as an indicator for the chip sector because it manufactures products that need those chips to function. And that's why we actually saw semiconductors really rally today. Nvidia was up 3.86%, AVGO was up
semis as a whole was just doing really, really well. ASML was up 7% for the day. Now, Nvidia stock was also boosted by investors looking ahead to CEO Jensen Huang's keynote speech at the CES trade show in Las Vegas. Investors will listen for signs its new Blackwell chip has shaken off supply glitches. We get that, stocks will rally. Now, another market mover today was Fubo. Fubo was up 240%. That is a huge, huge move in the market, guys. Absolutely crazy. And that was on the back of Disney confirmed that it will combine its Hulu Plus Live and TV business with sports streamer Fubo in the first major media deal-making move of 2025. Fubo shares saw 200%, while shares in Disney climbed about 1%. Disney will control 70% of Fubo, and the remaining shareholders will own the remaining 30%. In conjunction with the transaction, Fubo settled all litigation with Disney, Fox, and Warner Brothers Discovery related to Venue Sports, the planned sports streaming platform previously announced the trio. Now, this is absolutely crazy. However, if you're looking for momentum, the stock now has it and probably will go higher. We probably see $5 before the end of the week in this name. Now, the combination of the two businesses will create one of the largest digital pay TV providers in the US as consumers search for more cable alternatives amid increased cord cutting. Now, what also moved the market apart from stocks today was politics. We get something in the political realm every single day. And there was a report that Donald Trump plans less aggressive. And then in light of this, we saw Treasury yields increase ever so slightly, but the dollar dropped sharply as the markets recalculated the potential inflationary impact of the incoming president's plans. The index later pared some of its losses after Trump called the Washington Post report as well as fake news. So we'll see if this is true. Now, this could be a leak, but all in all, the market in the early parts of the day was really a positive on the back of this. However, fake news. So we'll see if this was maybe a fake leak, but the market reacting accordingly, particularly the dollar. We saw the dollar move in a significant way, and we'll talk about it on the charts. And all in all, everything together, we did actually see market breadth deteriorate ever so slightly. We saw about 2,900 advances, 3,300 decliners. But looking at stocks above their moving average, we continue to see positive developments. Stocks above their 150-day and 200-day continue to improve from yesterday ever so slightly and from a week ago as well. And we saw that across the board in the 20-day, 50-day, and 100-day, excluding the 5-day, which is very noisy. We did see market breadth improve across the board, and that's a very good. If we see continued follow through for the rest of the week, coupled with positive economic data, especially in the labor market, we're going to see stocks retake their 20-day and 50-day at the minimum before the end of this week. But that's depending on if stocks keep up the momentum and we get the data we want. It's a lot to ask from the market right now. Nonetheless, it is possible. Let's hop on the charts. And here we are on the charts, guys. And you can see equity is very positive, particularly large caps held together by the chip sector. Now, the Nasdaq 100 just above 1%. Now, guys, the market isn't fully closed just yet. It's about 10 minutes away from closing. So do be aware of that. So these changes may be a little bit different, but the S&P 500 up 0.43%. But look at the IWM virtually flat, the RSP virtually flat. And that's because, the market was very upbeat on the back of, Trump saying we're going to have less aggressive tariffs. But then the market actually did pare a lot of those losses as the day went on. If we just actually look at the RSP and look at the performance here in the single day, you can see we had very upbeat momentum, right? That's a pretty much a vertical move to the top in like half an hour. Then we got digestion of this move. Trump says right here, fake news, and then we just get lower lows, lower highs into the end of the day. And pretty much the RSP going from quite a positive session into a negative session right now, down 0.14%. If we actually just look at the percentage return, you could see at one point we were up 0.48% in the RSP. Very weird day of trade. Politics definitely moving the market, but that's how it goes. But when you do look at everything in aggregate, we continue to see consolidation right here in the RSP. The same is true with the S&P 500. In fact, the S&P 500 acting very strongly above the gamma flip, which is this orange line here. For those of you that don't know, this is the core resistance or the call wall. This is put support or the put wall. And pretty much above this line right here, you want to buy dips, sell rips, and aim for the core resistance 6100. Below here, you just want to be patient, buy dips when you get it and sit through the volatility and aim for us to take back the gamma flip zone and aim for higher levels. And that's exactly what we see right now. Quite a lot of volatility. That's not a very encouraging candle, particularly because bears sold the high on the back of the fake news comment from Donald Trump. Nonetheless, the Nasdaq 100 looks very, very positive. We're in positive gamma. However, yeah, these candles, these are like doji candles, gravestone doji candles. Not the best look if you're a technical charter. I don't like technical analysis. However, you do look at these candles and say, hey, bears did come in and sell the highs and sell those highs very aggressively. And that did coincide with yields rising quite a bit. 10-year yield was up 0.48%, the 30-year yield up 0.64%, but the dollar fell. So we're finally getting a breaking of the correlation where the dollar rises, yields rise, or the dollar falls, yields. Today we actually saw yields rise and the dollar fall. Bonds did not act that well. However, equities were very mixed. However, equities were positive in the large caps, mixed everywhere else. And then we actually saw Bitcoin, which really is a sentiment for risk, up 3.7%. So that risk appetite is still there. I think investors are just being selective on what they want to do, what they want to buy, what they want to sell, up until they actually get confirmation as to what's going to happen with the overall tariffs. Nonetheless, what we did see today on the back of those less aggressive tariffs was the market did light. So the market still has a bit of angst with regards to the tariff situation, and that still is the biggest driver of sentiment right now. And then how that affects yields and the dollar, and then how that affects markets and stocks as a whole. So guys, what we learned today is that if we actually get less aggressive tariffs from the Trump administration, it's actually going to be very, very positive for markets, and then more aggressive tariffs, not that good for markets as a whole. And less aggressive tariffs will actually see the dollar fall as a result, which is positive nonetheless. Commodities, guys, were also very mixed. But when we look at equities, we said in the weekend video that we want to see a couple of things. We want to see the RSP and the IWM. We want to see consolidation at these lows right here, and we want to see a move and a spring up to the gamma flip. If we go to the RTY chart right here, that's exactly what we see. We've seen a spring up, right? And now we want to retake this positive gamma zone. We were there a little bit, but bears did sell the highs aggressively, and now we're back into negative gamma. What I would love to see the Russell 2000 do this week, especially if we get the data we want. If we get positive data, we take the gamma flip and consolidate very similar to how we consolidated above the put support. We can get that, and then the move will continue. However, if we get negative data, maybe negative political sentiment, this is not looking too good, and then we may go down. And the economic data all starts tomorrow. Tomorrow we get the jolts. That's really going to set the tone for the rest of the week. So that's what if we get positive data, positive sentiment, we want to consolidate above the gamma flip and move higher from there. The same is true with the RSP, although I don't have the gamma flip zones for the RSP. And then the S&P 500 and the Nasdaq 100, we're pretty much already above the gamma flip zones. The key was to take the gamma flip. We just want to consolidate here, and with positive economic data and labor market data, we can then move higher, onward and upward to the core wall or the 6100 area in the S&P 500. And guys, what was so crazy today was that a lot of stocks in my portfolio were actually very, very positive. PayPal was up a lot today. PayPal was up at 1.96%, nearly 2.2% at one point. If we go to EVVTY, the stock has just been on an absolute tear, like literally just upward momentum, actually nearly closing that gap that we had after the UKGC report, up 2%. Guys, stock I haven't bought just yet, but Uber, very positive today, up 2.52%. Guys, if we actually look at another name I've been looking at aggressively, Estee Lauder, up 2.06% as well today. So very, very positive movements in all of these stocks I'm watching. That's actually what you want to see. Like a lot of these stocks have performed very, very well in the last couple of weeks when the broader market has seen a lot of churn. So that's exactly what you want to see. And then we look at Paycom Software today. They were up in a very big way, up 1.7%. But if we actually look at the highs of the day, very, very strong candle. And, I did say on the weekend video, this is probably where you want to buy Paycom Software, aiming for the highs, upside highs that could be anywhere from 15 to 20% upside into the next earnings report, which is just in about 2 to 3 weeks now. Paycom reports when pretty much all of the same week. Paycom reports when all of these mega cap stocks report. But all in all, guys, equity is looking constructive, particularly here in the large caps. As long as we hold the positive gamma zones in the S&P 500 and the Nasdaq 100, get the positive economic data we need, and then recapture the positive gamma flip zone in the RTY and see some positive momentum in the RSP, the equal weight, we will continue to move higher. But do be aware of the volatility, guys. I mean,
it could look like equities are doing very positive things. We can get a bad labor market report, and then stocks can continue the momentum we've seen in the last couple of weeks, which is just, this downward momentum, lower lows, lower highs. So this consolidation could act as one of two things, either a spring for a move down or a bounce for a move up. Is really just going to depend on the economic data and the rhetoric we get from the Trump campaign. Either way, I'm still a proponent of buying any dips. I do think we still are looking for a major low in the first quarter this year to take us higher into the second or third quarter, and then we can talk about volatility into the end of 2026. However, in the year and now, we're looking for a major dip buying opportunity. We may have already got it right here, but if the economic data is weaker than expected, that opportunity could come at lower levels. It just depends how the NFP report turns out today and the rhetoric we get from the Trump campaign. Nonetheless, we're going to be reactive to the market momentum, the market news and market sentiment, and be proactive and take the advantage where we can. And that means, or simply just waiting. Nonetheless, you know exactly what to do. We're officially back trading for the year, and we're going to make a ton of money.
And looking at sentiment, this is CNN's Fear and Greed Index. And what we see right now is that fear is driving the market. We've kind of known this for the last couple of weeks. However, if the market is to continue the rally that we saw at the end of last week into the remainder of this week, coupled with good data, based on all of the breadth we've seen, we should see the market push into the neutral and maybe even greed territory over the next couple of weeks. However, we are still in elevated levels of fear, and this is a time to be cautious, as well as a time for us to size up opportunities when they can. Now, guys, we are in a very important week this week with non-farms, and this can turn at any moment. However, buying into fear and buying into extreme fear has generally been a sound way to generate alpha in excess of market returns. Now, let's actually talk about the Santa Claus rally. Now, we didn't get it. The S&P 500 during the Santa Claus period, which is the last 5 days of the previous year, the first 2 days of the new year, those 7 trading days make up the Santa Claus rally. We saw the S&P 500 actually return negative, which isn't really a good sign, because they say as the Santa Claus rally, so goes January, and as January goes, so goes the year. However, when we look at it in aggregate, this could be a crystal ball of what is to come. During the Santa Claus rally, we saw large cap core or large cap blend and large cap growth actually see negative returns, -1% and -0.5% respectively. However, we actually saw a large cap value, mid cap across the board, and small caps too across the board return positive, especially small caps, 1.1%, 1.4%, and 1.1% in value, core, and growth returns, respectively. And maybe that could be the theme of this year, especially as we see a broadening out in the market. Nonetheless, the Santa Claus rally was originally based on the S&P 500, and it was negative. And generally speaking, when we get a negative Santa Claus rally, we see lackluster returns in the 12 months following. When we have a positive Santa Claus rally, we see 10% returns, and that is the average year in the S&P 500. But a more important stat we need to be paying attention to over the next month is actually if we break the December low, which is about where the Trump gap up is. That's where the December low is positioned in the S&P 500. If we break the December low anytime in Q1 of 2025, the returns in the final 3 quarters of the year tend to be very lackluster. You could see average returns of -0.2, median -0.1, and a very, very sad hit rate of 48.6%. So what we really want to do is hold the low. That's the Trump gap up. We want to hold that level right there, which markets are doing at the moment. If we can hold that, all bodes well for the S&P 500 for the rest of the year. However, there is a risk if we do go ahead and break it. And I think apart from the Santa Claus rally and this seasonal stat right here, the biggest risk to the market right now is actually earnings. History suggests that 2025 estimates have downside risks. You can see that the median path of earnings tend to see downward revisions throughout the year. That is something we haven't really seen so far for full year 2025 earnings. And if history is anything to go by, we should see earnings continue to move down, and that could pose potential downside momentum in stocks, particularly with where valuations are right now. But it's not just earnings that pose risk. There is some risk to the macro picture right now.
after Friday's close, we did see a massive pullback in the GDP forecast for Q4. This is the Fed's GDP now. It moved to the 2.4% level when it was above the 3% level, sitting at about the top end of the blue chip consensus. Very concerning to see growth pull back like that. I believe that was with regards to some of the PMIs and some of the data we got right before Christmas. However, growth above 2%, especially real growth, is actually still very, very solid. However, this is concerning and we do want to see an improvement here in growth overall. The higher, the better. And with regards to the market, its risks and things that can really affect stocks, right now, real yields are still very restrictive. For those of you that were wondering, saying, hey, we got a great economy, why is the Fed cutting rates? I believe one big reason was actually because of real yields. Now, real yields is just the Fed's fund rate, which is about 4.25% minus the inflation rate, which is about 2.5% right now. And that's how we get a real figure of 2%. That's very, very restrictive. Generally speaking, the Fed kind of want real yields at 0. That is kind of equilibrium. So right now, real yields at 2% at the 88th percentile is actually very, very restrictive. And this is part of the reason why the Fed is cutting, because these type of restrictive rate policies really do have a flow-on effect, particularly in markets like autos, manufacturing, the real estate market. These type of restrictive rates really do lead to defaults and economic woes down the line. You want to see this pull back to the 0% line. And this happens in one of two ways. Either inflation can tick up in a material way, or the Fed can cut rates. Now, we do know that the Fed don't want inflation to reaccelerate. How do they get real yields lower? They simply have to cut some more. And that's why we actually are embarking on this cutting cycle. It's all there to steepen the yield curve, which would lower the overall real yields. Now, when the yield curve steepens or the yield curve uninverts in our case, what are the returns we can expect? And generally, the yield curve uninversion, or steepening of the yield curve, tends to be very, very bullish for the market as a whole. The S&P 500 sees average returns of 15%, but where it gets really juicy is actually in the mid caps and small caps, seeing 28 and 36% returns respectively. However, we have a very thin pool of data, but data nonetheless that we need to look at, because yield curve inversions and uninversions are very, very rare. They don't happen every single day. So guys, this bull market will extend into 2026. Not without some volatility. So buy the dip, lock in, because we will go higher. History is telling us this, and we have the Fed on our side. Looking at earnings for the rest of the week, guys, we kick off Q4 earnings absolutely crazy. It just felt like yesterday we were doing Q3 earnings, but we kick off earnings here again. Not much to talk about, but we really get going here with Delta, Tilray, Walgreens, and Constellation Brands all reporting on Friday, and then Jefferies here on Wednesday. And then data for the rest of the week, we're going to take it day by day as it comes. And tomorrow, Tuesday, we had the ISM Services PMI, but I think the big thing that everyone's going to be paying attention to is the JOLTS data, jobs openings, JOLTS quits, and everything that comes with JOLTS, guys. So the numbers we want to look for, 53.5 or 54 for the ISM. And then job openings, we want to see 7.65 million to 7.69 million. If we can get positive revisions to the previous numbers, that would be good as well. And that's really going to move the market in terms of data. Earnings won't really move the market at all. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.